Stock splits is a situation where an issuer may decide to split their stock one way or another, either by increasing the number of shares, and they do that with a forward stock split, or they reduce that number with a reverse stock split. Um, the impact on shareholders is that after a certain date, they either own more shares, but at a proportionally lower price. That's going to be your forward stock split, or they own fewer shares, but at a proportionally higher stock price. And that's going to be the reverse stock split. Now, when it comes to stock splits, forward splits typically, it's a signal of confidence and growth in the company. Those lower share prices might stimulate activity. It's a mentality of an investor that they may not be able to afford shares at $1,000. You can't afford a single share at $1,000, but you might be able to afford 10 shares at $100. The dollar amount is the same, but you're thinking, I can't buy $1,000 stock, but I can buy $100 stock. So by lowering that stock price, it might stimulate trading, right? Because now I can't afford $1,000 stock, but I can buy $100 stock all day long. That might be the mentality that a shareholder has. Lower prices make shares more accessible to retail investors that have smaller budgets. So those are some of the reasons why there might be a forward split. A reverse stock split is typically fairly specific. The exchanges, in order for your stock to be listed on the exchange, there are a number of criteria that must be met, one of which is a minimum share price, and that minimum share price is typically $3. If your stock is below that minimum share price for a certain length of time, it is going to be in danger of getting delisted. And for a publicly traded company, that's not something that they want to happen. So what they would do, that publicly traded company with a low stock price, is they may boost that stock price through a reverse stock split. So with a forward split, a single share at $200 becomes 5 shares at $40. It's the same aggregate value. With a reverse split, 5 shares at 75 cents becomes a single share at $3.75. Again, you still maintain that aggregate, but the difference is with the forward split, it's lowering the price and increasing the number of shares that you may hold. With a reverse stock split, it's raising the price, but decreasing the number of shares that you hold. And with that in mind, it intuitively makes sense that there's got to be some way that those options are impacted. And this is how they are impacted. Let's first look at the forward stock split. Forward stock split comes in 2 flavors, if you will, an even ratio and an odd ratio. An even ratio is 2 for 1, 3 for 1, 4 for 1, et cetera, where there's an even number of shares before and an even number of shares after. An odd ratio, 3 for 2, 7 for 5, et cetera. The first number with the forward stock split is going to be how many shares you're getting in exchange for what you have. So you're getting 2 shares for every 1 share that you have. You're getting 4 shares for every 1 share that you have. That's how it is with the even ratio. Here's what happens when there is that forward stock split. The post-split stock price is going to be lower than the pre-split. So 200 becomes, say, 50 on a 4 for 1 split. And the stockholder owns more shares than they did before. So a single share at 200 becomes 4 shares at 50, right? The example that we looked at before. Options would similarly adjust. The share price and the strike price of the option would get reduced by the amount of that split ratio. The number of contracts that you have would increase by that split ratio. There would be no change to the trading symbol. There would be no change to the unit of trade. So it's still 100 shares per option contract would exchange hands in the as a result of exercise